Hello, and welcome to the Portfolio Matters podcast, the weekly podcast for private investors. This episode will see us review the macroeconomy and try to work out where we are and what that means for the coming year for private investors and for the assets that we can invest in. But first, that evil of modern life, the disclaimer. Richard, over to you.
Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end.
So I think the way we're going to organise this is that we have prepared a chart pack and we will go through each slide, discuss it and what it means for the world economy and the outlook for various asset classes. And so without further ado, let's move on to the first slide. This chart shows the change in UK M4, which is the UK's preferred measure of broad money, which is notes and coins in circulation plus bank deposits. And what this chart shows is that the Bank of England has printed an enormous amount of money during the year to support the government's fiscal expenditure. The UK is running an enormous debt. It's expanded its borrowing a lot of money to support everyone who can't work, and the health system, etc., etc.
And what do you think the consequences of this increase in broad money are, Keith?
Well, the most obvious effect is that essentially you are increasing the base money. So you're devaluing all the coins, notes and coins currently in circulation. You've increased the money supply. And normally that should lead to higher inflation. Now, right now, inflation is very low because nobody can actually spend any money. But the question is whether, when the economy gets back to normal, we have a surge in inflation. Now, this is a big topic that I think we will return to in some depth during the year, and we will focus on it in a week. But in order to understand inflation, you have to understand quite a lot of different factors, including demographics, globalization or retreat from globalization, the outlook for productivity, bank solvency, and unemployment. So that's a big discussion, which is slightly outside the scope of this particular podcast. But I think in summary, what I expect to happen is in the near term, we will see a surge in inflation. The question we need to ask is whether that initial surge in inflation persists or is a one-off. But if there is a return of inflation, the obvious thing that you need to do to protect your wealth is to move into hard assets. Now, I know we both have quite big holdings in gold. Bitcoin is another potential asset. Equities are real assets. The one thing you should absolutely avoid is bonds. So the next chart is Chinese fiscal stimulus. Now, before this year, all the debate was about the imbalances in the Chinese economy and whether it could continue on its current path, because the current path was unsustainable and leading to a huge debt buildup in China. And the commentators was essentially saying that China needed to rebalance towards consumption and away from this state-led industrial investment. Yeah. And what we have seen this year is nothing has changed. In fact, China has doubled down on its bet of statist infrastructure spending in order to support the economy. And so what this chart shows is that the national debt in China has increased by 11.7% year on year. Sorry, the debt to GDP has increased 9.1% and infrastructure investment has increased 11.7%. And I think you are seeing the effects of that in the real economy right now. So one of the things we talked about in yesterday's podcast reviewing last year was how the price of iron ore had hit a new high, and the highest it's been since the last time there was massive Chinese infrastructure spending in 2011. The same for copper. So we are seeing the effects of Chinese infrastructure investment right now. Now, the question remains how sustainable this is. Yeah. Richard, what are your thoughts?
Well, it completely depends how sustainable it is, doesn't it, Keith? Because, I mean, Chinese debt is at very high levels, and currently there doesn't seem to be anything stopping any government, any large country government issuing as much debt as it seems to wish to. For me, the issue is that governments around the world are borrowing sums of money that previously would have been unconscionable and would have been considered sufficient to bankrupt a country and to devalue a currency. And that simply isn't happening at the moment. And the question to my mind is, does this break? And if it breaks, when does it break? Because we, in inverted commas, have been thinking that this is an unsustainable path for a very long period of time. And to date, it has been sustained. So my view is we have to be careful that we don't draw immediate conclusions about what's likely to happen as a consequence of the increase in the debt, because the past tells us that this can take a very long time to come out. And in fact, we don't know, with a greater and greater central bank involvement, how it's going to come out and when it's going to come out.
I completely agree with everything you've said there, Richard. But I would say that any developments will be relatively slow. So you should be, if there's a pickup in inflation, you should see that happen over the course of years, giving you ample time to react. But it's something we need to watch and be aware of. And I think all these charts and this discussion really are things that should be on our horizon, not necessarily things which will lead to any immediate trades. But I would also say on the Chinese economy, what we've seen is small signs of growing financial distress in China. So state companies with enormous amounts of debt defaulting on their bonds. Now, in previous years, the Chinese government has always stepped in to ensure that these companies don't default. And now it's not doing so. And what does that mean? Does that mean that the Chinese government is moving to a more capitalist system where it does allow companies to rise or fall with the market? Or does that mean the Chinese government itself is financially stressed?
Yeah, I think it's a very good question, very interesting question, Keith. I also think we have this automatic assumption that we're making that if inflation goes up, interest rates will go up, and we also have this assumption that central banks can't hold the markets up, and I don't dispute those assumptions in the sense that they are necessarily wrong, but I would say that they may not necessarily be right. So the Japanese government owns, I believe, something like 60% of the Nikkei. And clearly, the Japanese government will continue to buy the Nikkei as long as it feels it needs to, and also if it starts to fall. And given that we've reached a point where it doesn't seem to matter if a central bank wishes to print $1 trillion, I'm not entirely convinced that central banks aren't able to hold up markets for a long time. If they do, I don't know what the final consequences will be.
I agree with everything you've said. The question is whether central banks make it a priority to support asset prices and what they do if and when inflation starts to pick up. Because there is a contradiction here. If you keep on flooding the market, well, the economy with dollars, eventually inflation should start to pick up. After all, Zimbabwe did not succeed in printing its way to prosperity.
No, absolutely. So inflation picks up, and as we know, the Fed has said that it's now set a bracket for inflation targeting, and it's going to be taking an average number, which basically gives it carte blanche to run inflation much higher than it currently is, 4%, for example, and say, well, if you look over the last 5 years, the average is 1.8% or whatever it might turn out to be, therefore we're fine. And of course, that helps to cut the burden of government debt. And as long as you keep interest rates low, it doesn't cause a problem in doesn't cause it benefits government debt.
Yes.
If interest rates go up, governments very quickly go bust. And so central banks can't allow interest rates to go up. Now, I don't know what the mechanics are of central banks saying we refuse to allow an interest rate to go up. I don't know whether market interest rates start to divorce from central bank rates, for example, whether lenders say, well, we don't really care what the central bank says. If you want to borrow this money, you're going to have to pay 8%. I don't see why that can't happen. But at the same time, I don't understand I don't see how we're able to continue borrowing at these levels and have central banks allow the interest rate that governments receive to go up.
Well, governments are, central banks are in control of domestic interest rates up to a point. So the Bank of England can set sterling short-term rates, and it can actually then do, let's say, Operation Twist, which would buy long-term bonds and suppress their yields, and
you can
issue short-term debt.
You can, but my point is that if I run a bank and we've got inflation of 5%, I run a bank, I don't want to lend at 2% because I'm making a 3% guaranteed loss every year on the principal that I lend. I will lend at 7%. The central bank can do all the operation twists it likes. I'm still going to lend at 7%. So
that's true. And actually
in the real economy, not the economy that is this Ponzi scheme of government debt that we're now in the real economy, the central bank can't control interest rates.
That's true. And actually, if you look at the yields charged on credit cards, they are currently, I think, at all-time highs. They're certainly very high. So I think your point is very well made, Richard. But the one thing I wanted to talk about was the fact you can control sterling interest rates only up to the point you don't require overseas investment. And in the case of the UK, where we run an absolutely enormous current account deficit, we require constant overseas funding. And the other thing is, you can control our interest rates, but you can't control our exchange rate. And so if people decide that UK is not a good bet, you will see a massive decline in sterling.
Yes, leading to more inflation.
Okay, so moving on. UK unemployment. Now, UK unemployment is obviously very elevated, but actually is not as high as you might expect, because the government has really stepped in with its furlough scheme to keep people in employment, even though they're stuck at home not working. So the thing I wanted to talk about with this chart was the huge difference between market returns, the state of the the markets, which are doing very well, and the S&P 500 is an all-time high, and the Nasdaq returned 46% last year, and the real economy, where output remains depressed and unemployment is high. Now, to briefly return to the inflation debate, it's difficult to see sustained inflation when we have high unemployment.
So I think I would agree with you, Keith. I would also say that that line is going to go significantly higher when furlough schemes finish. And I think these lockdowns have caused and will continue to cause huge damage to the UK and other countries' economies, which have been hidden by government stimulus and support.
I agree.
At some point, that will come out in the unemployment numbers.
And I also think, Richard, that one of the things we talked about yesterday in our review of the year was the very poor performance of UK banks. And I think what this is telling you is that the bank shares are poor because people are expecting a lot of bad debts.
Yes.
So the economy is not in as good a shape as just looking at the markets might lead you to believe.
And there will be business bad debts and personal bad debts. And
Absolutely.
At the moment, both of those are being suppressed to an extent by furloughing and business support.
Absolutely.
There is an interesting question here, which is, are we going to see, can you imagine an economy that operates differently to the one that we're used to? In other words, can an economy operate effectively where no one goes shopping? Well, and nobody goes out to party, nobody goes out to nightclubs and pubs and so forth. Well, the answer is actually, yes, you can. So my question now is, are we going to permanently lose quite a significant chunk of the economy?
Well, I wonder whether you can successfully run that economy, Richard, because you do need people to provide lots of services. And not everyone can be stuck at home. And the reality is, we're now dependent on lots of gig workers who are working for Amazon and Deliveroo.
Yeah.
And so what we seem to be splitting into is a lot of people who are essentially enforceably at home, and low-paid workers who are working very hard. To me, the economy doesn't work at the moment.
It seems to me you could sort of split the economy into thirds, very approximately. So 2/3 of it is manufacturing and services related to manufacturing, and 1/3 of it is leisure. And I don't know what the actual numbers are, but we seem to be able to do without leisure, or leisure at home as opposed to leisure outside. So my question is, does leisure actually, it will come back to an extent, but can you then have an effective economy that operates without leisure? Well, you can, but you have a significant drop in overall demand in the economy.
Yeah. Yes, I agree with that. But in the UK, the manufacturing sector is only about 10% of the economy. We are far and away a services economy. And what essentially you're saying, Richard, is that if a lot of those services go away, so let's take, for example, hairdressing. If nobody's having their hair cut in anymore by the barber and they're doing it at home, or they're getting their wife to do it, then you're getting rid of a whole sector, you're creating unemployment. People need to then retrain, and demand has gone down. The kind of circulation of money will decrease, and fundamentally you've depressed economic activity and taxable economic activity. Yeah. GDP will go down.
Yeah. Who knows? We shall see. But there is a scenario that could play out in that way. But I'm not saying it will.
No, absolutely. But what you're essentially saying is that we have a smaller economy as measured by GDP, actually, people paying each other for goods and services. That doesn't necessarily mean that people would be less happy, although frankly I suspect they would be stuck in their homes for very extended periods of time. But our economy as is depends on people paying for things which, you know, provides wages and tax. And if we're not doing that anymore, then I think we have a problem.
I think we do. What's the next slide, Keith?
It's inflation again.
Okay, shall we move on to the next one? I think we've done inflation.
Yeah. Okay, well, this is interesting. Bankruptcies, very low.
So clearly, this is the consequence of the government business support. And without business support, I guess the line that droops down to almost 2,700 or so would be going in the other direction, which is very sad. And at some point, those businesses will go bust.
Absolutely.
It's been
the point I would raise from this graph is just how low bankruptcies are. They're lower than when the economy was doing quite well. So what this is telling you is that we've created a load of zombie companies which can't survive, and at some stage they will have to go bust. So at the moment they're being supported by the government, but when those schemes run out, there will be a spike in insolvencies.
There will be.
So essentially we've delayed a reckoning.
And that then impacts or doesn't impact the bank's shares, depending on whether they've provisioned appropriately for what's coming.
Precisely.
And I think, just as a little aside there, I read recently that the view that the European banks are woefully under-provisioned against bad debts as a consequence of coronavirus.
Yes. And I wonder how investable the bank sector is, because the reality is none of us know what the state of their loan books are and how they're provisioned.
Yeah, I would agree with that, Keith.
Okay, so next slide. Small business revenues in the US. And what this chart shows is that actually the US, there has been a great deal of stress. So although the financial markets have strongly recovered, small business revenues and activities is well down by 32%. And that is before the recent resurgence of the new variants of the COVID-19.
And you have to ask yourself, really, I'm not quite sure what proportion of the US economy is made up by small businesses, but it's in the UK, I think it's 60 or 70%. And you have to ask yourself, well, if such a large chunk of your economy has taken such a large hit, how can the economy be roaring ahead in a way it's suggested by the stock market? And there's this massive discontinuity between the real economy and what's going on in the investment world.
Absolutely. So in contrast to the state of small companies, the US and actually the British consumer are in remarkably good health. So all the money that governments are spending will eventually end up in somebody's pocket. And when you look at the savings rate in the UK, it's gone through the roof. Actually, people have done okay because the government has stepped in to pay their wages. And so when you look at spending has held up remarkably well. It's now down, in the US, it's down 1.7% year on year, and that's before the annual Christmas surge.
So the interesting thing here, Keith, is if small business revenues have dropped by 30% and the spending is effectively unchanged, where's the spend? Where's that 30% of small business revenues gone?
I think we know that, Richard. I think it's gone to Mr. Bezos. Essentially, you can't go to the pub, you can't go to, in the London at the moment, all small businesses, unless they're essential, are closed. You can't spend money. The only thing you can do is buy services from these big online retailers and service providers, such as
so it's gone. Actually, what's happened is it's diverted spending from small businesses to large businesses.
Precisely, and to very particular large businesses.
Yeah. And potentially very detrimentally to the long-term health of the economy.
Absolutely. And also these very large conglomerates like Amazon, do they pay any tax in the UK? So moving on, as we discussed previously, consumers have savings. So this chart, which comes from the Office of National Statistics, shows UK household savings ratio, which has absolutely shot up. So people's wages are being subsidized by the government, supported, and they can't spend it. So it's going into paying off debts and into bank accounts. Now, what that means is when the economy, so when the lockdown ends and people are actually allowed to spend money, they have the resources to do so. So there should be a strong recovery.
A mini boom.
Absolutely.
Okay.
Moving on. Now, the following charts tell a story, but they are there's quite a lot of text in them. So to go through them, what this shows is how the US fiscal stimulus, which has been enormous, has affected the overall balance sheet of Americans. And what it shows you is that American consumers have got a lot more money at the end of 2020 than they had at the end of 2019, despite the terrible slowdown and the recession in the US. Now, how's that happened? Essentially, their decline in wages has only been minus 43 billion. So despite all of the companies going bust, or not going bust, but not doing any activity, and they have not laid people off as they normally would have done because the government has been paying wages. So total wages have only gone down by 43 billion. But on the positive side, total income has increased by 1.3 trillion. So in aggregate, US private people have a total of 1.03 trillion more US dollars at the end of 2020 than they had at the start of the year. And that is the same. So the picture in the US is the same as in the UK. Consumers have money. The savings ratio has gone up.
And effectively, then, when these lockdowns finish, we shall talk about that in a minute, but when the lockdowns finish and we go back to normal, there's a huge pressure of consumer expenditure waiting to come out to cause Absolutely. A mini boom, some inflation, whatever.
Yeah. So they've got lots of money. What have they spent it on? Answer, they haven't. So actually, spending has massively decreased because people can't spend it. They can't go on that trip to Vegas. There's been a small increase in durable goods like home gym equipment.
There does seem to be some conflict between the various sources of data here, Keith, which is quite interesting because the graph earlier said that consumer spending was pretty much unchanged. But here we've got, and it may be how you interpret the data and different analytics give different results. Yes. Because we've got spending decrease, but whether that's a decrease as a result on total income or whether there's some conflict in the data is difficult to tell.
But that's very true, Richard. But also, we don't know what the denominator is because the last graph was in percentage terms.
Yeah.
this is in absolute terms.
Yeah, that's a good
but
point.
I take your point.
Yeah. What we can certainly say is that there have been some huge swings in consumer behavior, consumer income.
Absolutely. And this reiterates the message from the last two charts. Essentially, US consumers have enormous savings. So what does that mean? Well, the story this is all building up to is that people are stuck at home and they have a lot of money and nothing to do. And when we look at the behavior of investors, it seems that there are a lot of new investors who come into the market. They are buying the most speculative stocks. And part of the reason that the US stock market, all stock markets have done very well, is a wall of money from private investors.
The interesting thing about this graph is, Keith, is that the peak in margin debt is pretty much equivalent to the peak that we had in 1999-2000, just prior to the crash, and in 2007-8, just prior to the crash. And of course, people who buy on margin are the first people to sell, aren't they? Because the pain of holding a share you bought on margin as it goes down is multiple times the pain of had you bought it out of cash.
Absolutely. But the one thing I would say, just from looking at this chart, Richard, is that the peak in margin debt is telling you that you should be thinking about getting out, but it's not a contemporaneous indicator. So if you look at the charts, the peak in margin debt, and bear in mind, margin debt has not yet peaked. It's rising, but it hasn't peaked yet. And the peak in margin debt is not the top. It is some months before the top. So what this chart is telling us is that you should be considering getting out, but there's no need to panic about getting out.
I think that's a very interesting point, Keith, and I think that is quite a nuanced interpretation of the graph.
According to this chart, there is 100% correlation between peaks in margin debt of this magnitude and large future sell-offs.
Yeah.
Richard, would you like to talk about this one?
Yes, I think this chart is totally extraordinary.
Yes.
So this is the average volume of call options, and there's another statistic, I think, isn't there, which we haven't got in the chart pack, which is that small traders who buy lots of 10 or fewer call options have been incredibly active, and this 20-day average call volume has basically doubled from what it has been for the last 12 years, 10 or 12 years, and it's doubled in the space of 2020. And what that suggests is that the doubling has occurred because small investors have decided that the market is a one-way bet, and if they buy a call option, then when it expires, it'll expire with a significant profit, and presumably then they roll their profits up and double down. And of course, when options are purchased, the option dealers, they actually go into the market and buy the underlying. If it's a call option, they go into the market and buy the underlying stock. The opposite happens, and the dealers go out and they will sell the share that they purchased to offset their risk. And so the whole movement of the market gets magnified by this dynamic.
Absolutely. No, I think this chart is absolutely extraordinary. The one thing I would say is that how much of this could be just a one-off shift to higher volumes based on a reduction in the price, or so the cost of trading? Because we have seen the development of these free trading platforms in the US, such as Robinhood, which we don't have in Europe. And that has been associated with an enormous increase in trading, because trading is now free. So rationally, people do more of it.
Yeah.
But you would expect to see a symmetrical increase in call and put volumes. And I don't think that's what you're seeing. You're just seeing a massive increase in call volumes.
I also think, Keith, that if you look at the way this chart has evolved over, and it's a linear chart, from 1992 to 2002, 10 years, the number traded increased by 2 million, let's say. You had a sharper increase from 2002 up to 2010. But the increase we've got here is just extraordinarily out of proportion to those increases.
Yes,
which
I agree.
suggests some sort of speculative fervor, which generally, I'm not saying there's any particular timescale to it, but generally people who get caught up in speculative fervors get caught out by them as well.
I agree. And I think we are painting a picture of private investors with money and time on their hands, unable to earn money via their normal jobs, attempting to make money from the stock market, and actually doing so very successfully currently.
Yes.
But at some stage, you have to convert those paper profits into cash profits, and at which point you could get a stampede out. And the indicators we've just talked about are all showing that although we may not be at the peak, we are approaching it, and the time may be now when we should start taking some profits.
So I emailed you this morning, Keith, didn't I? The paper by Jeremy Grantham, which is available on his website, and a friend of Keith and I, who runs works in a private office, sent an email back, and he said, thanks for sharing this. For me, the line in the paper that says 1999 was the only experience we have had of clients reacting as if we were deliberately and maliciously depriving them of gains. What he's saying is that there is an atmosphere in the market where it says that private clients, if fund managers don't invest in the market, the private client is accusing the manager of being maliciously depriving them of gains. And that was a precursor to the 1999 crash.
I think that's absolutely true, Richard. But with the Jeremy Grantham paper, he was saying that he called the top in technology stocks in 1997.
3 years too early.
3 years too early. Now, I personally called the top in technology stocks in 1996. So I was even more wrong, and then had to sit out the market as I watched, lastminute.com, etc., soar for another 4 years.
So the message is be cautious and be aware, isn't it?
Absolutely. So what we're saying is that we may not be at the top, but we are definitely in a bubble. And the question really should be not whether to get in, but when to get out, and to take a bit of money off the table. So on that note, this chart, do you want to talk through this chart, Richard?
Oh, smart money and dumb money. Yes. I always find it slightly offensive that I'm referred to as dumb money. Apparently, dumb money buys at the open. So if they my understanding of this is that they take the number of trades at the open, and they assume that's dumb money, and then the smart money trades during the day and nearer the close. Right. And so smart money is institutional managers, and dumb money is people like me, who is a private investor. And I do tend to buy near the open, so I am, in that sense, I correspond to the dumb money definition. What it's saying is that the dumb money confidence is at 95%, i.e. about as high as it's been, 85%. And smart money confidence is at 20%, 25%. And what the implication being that the smart money is right, dumb money is wrong, and that we're due a crash. well, we'll see, won't we?
Well, when I look at, you can do this visual correlation between previous highs in dumb money confidence and subsequent returns. And it's true that highs have been generally associated with peaks in the stock market, whereas peaks in smart money confidence tend to be associated with lows in the stock market.
It's a fairly approximate. Is it an indicator? I'm not quite sure.
Yeah.
But it's an interesting graph.
Yes, absolutely. Again, this is backing up the earlier chart showing the massive increase in call options.
Yeah.
So, where does that leave us?
Well, I think we actually put this chart together a couple of weeks ago, didn't we, Keith?
Yes.
And I'm wondering whether, I'm just looking at the equities, UK bullish.
You see, I remain bullish actually, but I think you have to be quite differentiate between different sectors. Yeah. And the thing is, in the first few days of January, we're talking on, I think, the 6th of January, we have already had an extraordinary performance of the UK stock market. Yeah. So the stock market is up 2.5% today. Now, when I was bullish, I was thinking, well, I can see the stock market returning 10% this year.
Yeah.
And we've actually had very strong performance in the first few days. Now, going forward, the UK stock market ended the year down 15% in 2020, whereas all the other stock markets of the world had largely had quite strong positive returns. And I do expect the UK to catch up. But whether there is a strong near-term peak followed by a drift or fall later on in the year, that would probably actually be my base case. I think we're heading for a short-term peak.
Can I just chip in here, Keith, come back and say, when we were discussing interest rates, and I made the comment, I didn't see why at some point private sector interest rates don't simply diverge from central bank mandated rates. And at the moment, equities are sort of being discounted on very, very low interest rates. And that's one explanation for why we've got this boom in the equity markets generally. If I was right, and let's say we have 5% inflation and banks charge 7% for a loan, then the rate you need to discount at becomes 7%.
Yeah.
If you discount the earnings of companies at 7% as opposed to 2%, you get a massive change in valuation and a massive reduction in valuation and a massive reduction in share price. And the danger, I would say, is that the discounting rate that is currently being used for valuing equities is simply wrong. And at some point, it will correct itself. That's the point when the market will drop.
Okay, which naturally brings us on to the outlook for interest rates. And actually, we did do this chart, this table, probably 3 weeks ago. Now, interest rates, they're very low. You see, I am really unsure about how they're going to go. And I think the long-term interest rates are potentially very unstable. So I don't know. I think the danger is we have volatility and quite large volatility at the long end. If we have a pickup in inflation and the markets suddenly decide that this is not just a passing phase and inflation is persistent, then you could see very sharp movements in the long end, which would be very bad for equities. So my takeaway on bonds is I would just avoid them. I think the risk return profile is extraordinarily bad.
Yeah. I would agree. I think that if interest rates drop, then there will be a capital gain in the bond, but the chances, the danger of being in interest rates where there's so much money sloshing around the financial universe in such an unpredictable way, it's very, very difficult.
Well, actually, talking about the amount of money printing, gold. People are printing a lot of money. It's like, yeah. I think it's got to end up somewhere. And frankly, as there's enormous amounts of debt, and the great thing about gold is it's a hard asset, is not a claim on anyone else's future income.
Yes.
And, as they print more money and inflation, there's potential of inflation, I expect people to not invest in bonds and actually to look for a hard asset, which is gold.
I would agree. I think it's quite volatile. I think you need to be able to hold your nose and put up with the volatility. But I think that in the long term, it will go up significantly in price.
Oil, as we've talked previously in previous episode of the podcast, oil is an artificial market at the moment. And I would roll back slightly on my previous bullishness, and I think that in the last few days, oil has absolutely shot up on the rollover of the OPEC plus agreement. And I think a lot of the good news is already in the price, and we would need to see a sustained recovery in the world economy, which requires an end to all these lockdowns before oil can make further progress.
Mm-hmm. Commodities. We discussed commodities in the previous podcast.
We have, Richard, but actually, can I come in here? Because actually I'm going to reverse course.
Right. In
that I think commodities have gone too fast too quickly.
Yeah.
When you look at copper, iron ore, they've just gone too far. They've gone too far too fast. And actually, I'm now kind of bearish, actually. In the course of the last month, it's just got a bit silly.
I definitely think that the rare earths that we talked about, copper, there is going to be a continually increasing demand for them for years ahead.
Great.
But I think that the recent spike in prices that we've seen, particularly in the producer prices, producer companies, has probably gone too far. Will probably pull back and will probably be a better buy at some point in the future.
Absolutely. Sterling. I have been wrong on sterling continually, but I remain cautious and slightly bearish about sterling. I think that markets in general find it better to travel than to arrive, i.e. that they always look optimistically at the future and then find when reality hits they've been slightly too optimistic. And in the case of sterling, I think now we have Brexit, that we were going to discover what the costs are. So I think there's going to be bad for our balance of payments, which is bad for sterling.
Bitcoin. Please talk to us about Bitcoin.
Well, as I know absolutely nothing about it, I'm going to leave it to you, mate.
Well, I went into it in some detail, superficial detail, in a previous podcast. I do think that the future for disintermediation is strong. I do think that Bitcoin is tied into that future, and that's the basis of my bullishness on Bitcoin.
Great. The one thing I'd say is, in order to hold any speculative asset, I think you need to be confident in it. In that, if you're not confident and you buy Bitcoin, not really sure about what you're holding and not really sure about its value, then you will tend to be knocked out of the trade the moment it goes down because you don't have a confidence in it.
Yes.
So I think in order to hold Bitcoin, you have to be confident.
You need to have a foundation on which you have based your view. And if you don't have that, any
Yes.
price changes have no context. There's no frame of reference in which you can judge the price change. And that frame of reference is really important. So Keith knows a great deal more about the oil market than I do. So his frame of reference is much clearer and more stable than mine.
Absolutely. And Richard knows a lot more about Bitcoin than I do. So I will leave that one to him. Okay, so moving on. So what are the dangers of the coming year? And frankly, I think there are a lot of dangers. And this is one of the reasons that I am concerned about the elevated levels of equity markets, because I'm expecting a volatile year. In particular, the outlook for inflation. We know that when the world economy is allowed to recover, that there will be a spike in inflation. Now, that could be short or it could be long, but that will mean to have a lot of consequences for debt, in that if inflation rises, then interest rates rise and the cost of servicing debts rise. And with enormous levels of private debt and companies very highly geared, that will cause stress.
I agree, Keith.
There is the perpetual danger of a Chinese financial crisis, which people have been forecasting for the last decade now, but remains something that we should watch. And as we discussed earlier, recently there have been indications of financial stress in the Chinese system. So state sponsored companies defaulting on their bonds, which is not something we've seen before. And I'm not necessarily forecasting there is a problem this year, but it's something we need to continue watching.
Hidden economic damage from COVID, we've discussed. I think only really when the lockdowns end and governments start to withdraw the support that they have given will we really see the dimension of the economic damage. And hopefully it will be less than we fear, but I think that it will be significant. I also think that we may not have a clean end to COVID. Yes. I think that the chances are that the virus will continue to mutate. The possibility is some of those mutations won't be susceptible to the vaccines we currently have. And new vaccines can be developed and administered, but that will take a little bit of time and can continue to cause disruption for a period of time longer than getting the current vaccines into the population. I see that as a risk on the horizon.
Well, I think you raise a very valid point, Richard, in that so far, I think everyone has consistently underestimated how long this is going to last. And we are now in this bout of optimism that the vaccines are going to be a magic cure. But as you've pointed out, the virus is mutating, and the new virus in South Africa appears to have different spike proteins than the ones that the vaccines are designed to work against. So the danger is that this crisis just rolls on.
So we don't actually know whether that's the case yet for the South African one, although I think it has 6 amino acid changes, which is quite significant for the potential active sites that combine with the antibodies that are produced by the current vaccines. I was looking at the spike protein just before we did this podcast, and it contains 1,200 amino acids. Now, it's a hugely complex molecule, and the potential for a lot of those amino acids won't really be in a location which is amenable to an antibody. So a change in that may not be particularly significant, but many of them will be in an area which is amenable to antibody development. And so there's such a vast opportunity for mutations to occur, I think it's almost inevitable that we will get variants that aren't susceptible to the current vaccines. Now, that's the same as the flu virus. So every year we're given a new flu vaccine, and the vaccine contains, it's actually a vaccine to a number of different flu strains, not just one. So it's not something we haven't encountered before, but I think we need to factor that is probably quite a likely route that we will need to take for the COVID vaccine as well.
Right. So I think the key point is that there is an uncertainty about the length of the recovery, and financial markets don't seem to care at all currently. They are discounted a fast and total recovery. So moving on, governments around the world have borrowed absolutely astronomical amounts of money, and that is clearly unsustainable. At some stage, government finances have to return to a sort of balance. Now, that can either come through cutting expenditure, which is austerity and therefore deeply unpopular, or it can come...
Austerity, I suspect that austerity is basically is not possible because of the consequences of austerity after 2008. I
agree.
It's unacceptable, so the government won't really be able to go down that route.
I completely agree. And actually, that would bring us on to our final point, which is social unrest. I think there is no appetite for austerity. So the alternative is higher taxes or inflation. And inflation is a way of reducing your debts without increasing taxation. And I think the reality is you will probably have to have a combination of both. Now, the question is over what timescale you have inflation, but in the long term, I can't see a way out of the very high levels of government debt without some inflation.
I agree with that, Keith. It is short of completely resetting the financial system, which people talk about it, but in reality, it's almost impossible to do in any controlled way. The inflation is the way out.
Absolutely. So I'm not saying that is something to be necessarily worrying about in the coming year, but in the medium term, that is the big danger. And as we previously discussed, we will be returning to this again and again, because inflation is the most important factor in determining where you put your money.
I agree.
So I think that brings us to the end. So all that remains is to thank you for watching, and I hope you'll join us on a weekly basis as we proceed with our weekly podcast in what looks to be an extraordinary year in the markets. If you've enjoyed this, I hope that you will press like and subscribe to the channel so that we can attempt to find a few viewers. And I look forward to seeing you next week. So all that remains is to say goodbye from Richard Wheater.
And goodbye from Keith Jordan. Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information. Nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.